In this edition of Word on the Beach, monthly market insights from Green Street Advisors, Andy McCulloch, senior analyst with Green Street Advisors, talks a little bit about the U.S. apartment picture. The apartment market staged an impressive and somewhat surprising recovery in 2010, especially considering the weak employment picture last year. So Andy, do you expect the positive trends in apartment demand to continue in 2011?
Simple answer is yes. Green Street does expect those positive trends to continue this year. The U.S. labor market is expected to improve in 2011, which should drive an increase in the number of household formations. And given that we expect the homeownership rate to continue to trend downward, that means the rental market will capture the lion's share of those new households. That means the demand side of the picture is pretty good. When you combine those positive demand trends with the lowest level of new supply entering the market in 2 decades, that sets the stage for a pretty good environment for apartment operating fundamentals.
And when you're looking at expectations for rent growth this year, how do your expectations vary by market or region?
Green Street expects growth to be pretty broad-based in nature. In fact, we're forecasting positive RevPAF growth in every major U.S. market, with growth ranging from 3% to almost 10%. And RevPAF is a metric that combines changes in effective rents and occupancy. To touch on some of the main REIT centers, we expect the Northeast and the San Francisco Bay Area to put up some of the strongest numbers. Washington, D.C. and surrounding markets, which were really the stars of 09 and 010, we expect to moderate but still be in the middle of the pack in terms of RevPAF growth. And then Southern California, which while we still expect growth to be positive, we expect it to be a relative laggard.
And what does all this mean for the REITs and their reported results?
What it likely means that the REITs are going to report pretty healthy revenue and NOI growth in 2011 and even better growth in 2012 as operators continue to roll leases into higher rental rates.
In many ways, the U.S. is on uncharted ground on many economic and political fronts. What are some of the risks to your outlook?
I think the biggest risk to our outlook is continued weakness in the U.S. labor markets. Apartment rents can really only outpace weak job and weak income growth for so long. The shift in attitudes away from homeownership can buoy rents for a while, but the strong growth we witnessed in 2010 will begin to moderate if the economy doesn't start to produce more jobs. The other big risk is the loss of households to the owner market, given the dramatic improvement in affordability that we've seen. But we see that as a risk coming into play in 2012 at the earliest, and it could be even farther out than that if the upward trend in mortgage rates that we've seen recently continues.
Okay, so in addition to fundamentals, in 2010, the acquisition market also kind of came to life a little bit, especially when you look at pricing for trophy assets. Do you think pricing may be starting to get a little high or creating a bubble? What's your take on that?
Green Street's Commercial Property Price Index, or CPPI, shows that apartment asset values are now less than 10% off their 07 peak, which is pretty staggering given what the overall economy and the job markets have gone through in the last 3 years. But if you compare return expectations in terms of unlevered IRRs versus prevailing bond yields, private market values look to be at reasonable levels, and that's even after the run-up that we've recently seen in treasuries. Now, that is a change from a few months ago when we viewed private market asset values as being on the cheap side of fair, but at this point we don't see asset pricing approaching bubble levels.
Andy, thank you very much.
Thank you, Matt.
The apartment market seems poised for another strong year in 2011. For more on this and other news and information, be sure to visit REIT.com.